Let's go live now to Nikki Hutley from Deloitte Access Economics. I tell you what, Nikki, watching the share market in both Wall Street and locally is a little bit of an emotional exercise at the moment. New highs are often followed by lows again. So what can we expect today?
Look, the share market's going to open a little bit down today off the back of Wall Street. But, you know, we are seeing fundamental strength in the equity markets. You know, if you compare where the Australian markets, how long it's taken us to get back to those pre-GFC highs, it's taken us a lot longer than the US or other parts of the world. So, you know, this has long been awaited for. We do know, of course, though, that the overall economy is a little bit sluggish, and people do need to be careful when they're looking, you know, at individual companies to, you know, what are the fundamentals. But you know, especially with interest rates heading further downwards, both here and overseas, then the outlook for equities looks broadly positive at the moment.
Well, Nikki,
hold on to your seats.
sorry to interrupt you. Yeah, I mean, you make a point there, but the US markets, well, GDP the growth is what, about 2.1% at the moment in the US, which is only marginally better than us. Does that help or hinder us?
Well, it probably helps us in a way in terms of equity markets, because we're now talking about pretty well 100% chance of the US FOMC cutting rates by around 1/4 of a basis point, so the target range down to 2 to 2.25 this Wednesday. And obviously lower interest rates elsewhere is going to, I guess, support or indicate that we're headed for lower interest rates here as well. That 2.1% GDP was possibly not quite as bad as it might seem. I mean, strong government spending and really good consumer demand was the key. But obviously, business investment, negative sentiment, particularly around the trade wars. You know, that idea that Trump had that it was going to be a win-win situation. No one wins from a trade war, unfortunately.
As you say, the US Federal Reserve is expected to cut rates this week, but it was expected to cut last time around. What are the different factors this time?
Well, I think one, we've had that GDP number out, and it's, you know, cemented in people's minds that the economy has slowed. But I think more importantly, you know, we're seeing everybody right across the range of FOMC members being fairly dovish in their outlook, and regardless of what Trump wants or doesn't want, I think by and large the consensus of the FOMC is we need to cut in a precautionary sense now, get in ahead of the curve and get those rates a little bit more flexible. Of course, they've got more room to move than we can, so 1/4 of a basis point just to improve, if nothing else, confidence would be a prudent thing for them to do at the moment, and that's what they've indicated.
So you think they will?
Yeah, I do think they will.
Yeah. Because there's been a lot of talk about it. I say that because there's been a lot of talk about it, and it hasn't really changed.
No, but I mean, sooner or later they have to come to a conclusion that, you know, have things changed significantly for them. And I do think that, you know, all of the indicators point to, you know, we've got certainly slowing business investment, which is not a good sign. And we've had some great labour market figures. We've got good consumer spending at the moment. But that momentum, that 4% odd increase that we've just seen in consumer demand, that's not going to keep pace. And there's a little bit of weakness perhaps around the housing market as well. But particularly on that business investment front, I think they need to see something to stop that momentum, because the economy is always, you know, it's always got that momentum, and it's either going down or it's going up. And in the US at the moment, it's headed downwards.
Can you explain, Nikki, this might sound like a really silly question, but let's say the Federal Reserve cuts its interest rates. What does this mean for us, for Joe Blow down the street?
Well, in the first instance, it probably doesn't mean that much at all. But where it does flow through is if the US has stronger growth, that's good for the rest of the world. It means demand's going to be stronger, our commodity prices will be stronger, that means our national income will be stronger, our Aussie dollar probably will be a little bit stronger, which is less on the positive side from a global economic or broader macroeconomic perspective, but good for Joe if he wants to go on holidays to Bali, I guess.
Good on you, Joe.
But, you know, overall, Australia is a very small, open economy, and we are trading in a giant world, and we are a little bit like a small boat being tossed around by large ships that go past us, those large ships being predominantly the US and China, and as their weight goes past, our smaller boat gets a little bit of a rocking. So we're never immune to what happens in the, the global environment. So it's very important to us, particularly with those two largest economies, to understand what's going on there.
And the seas might be choppy, Nikki, but we never sink, it should be said.
Well, not for a long time.
Yeah.
Thanks, Nikki. Appreciate it. Thanks, Captain Pete.
Yeah, no worries at all. Just giving you some positivity on a Monday morning.